Now, don't be fooled by today's modest moves in the stock market. This month has been big for investors. In fact, it could be one of the best in a very long time. Optimism has been improving over the past few weeks, but today there was some caution ahead of the trade talks between the U.S. and China, which are set to take place later this week at that G20 summit in Japan. So today, the Dow Industrial Average rose just 8 points to 26,727. NASDAQ was down 26. The S&P was down 5. And today, despite these small moves, recent rallies had sent the major indexes close to new highs. But does this month's move higher have staying power? Mike Santoli takes a look.
This trip to a fresh record is perhaps the most confusing in terms of how it happened and what comes next. It has come with Treasury yields anchored near 30-month lows, recession fears swelling, and manufacturing activity stalling. The rally has been driven by defensive stock sectors such as utilities, and gold has broken out to a multi-year high. Investor sentiment has been quite cautious, which has a way of boosting stocks in contrarian fashion. Purely based on the historical probabilities, a market at a new high and up more than 17% not quite halfway through the year are reasons to believe more upside lies ahead, but also are cause to keep expectations in check. The Dow Industrials have made a record high in the month of June in 33 previous years. Second half performance in those years is roughly the historical average. For all years, that's a gain of more than 4%. And the S&P 500 is on pace for the strongest first half since 1997 and one of the 5 best in recent decades. All years with similar returns by this point finished the year with further gains. Such historical studies provide context, but no clear course of action, of course. The big picture is the market has been in a wide swinging but ultimately sideways trading range for a year and a half. It's now stretching the top of that range. Earnings have flattened but not begun falling, and the market fully expects the Federal Reserve to start cutting rates next month. The initial market reaction to the first rate cut in a cycle tends to be quite positive, but the strength only lasts if recession is averted. So have stocks already priced in this Fed effect? And will the second half confirm the market's implicit belief that the economy can keep outrunning a sharper downturn? For Nightly Business Report, I'm Mike Santoli.